private debt, real estate, and unique assets like cars, wine, the future earnings of up and coming sports stars, and much, much more. Yet now there are millions of individuals investing billions of dollars every year into every asset imaginable across hundreds and hundreds of digital private marketplaces. At KingsCrowd, we're committed to providing best in class education, research, and data to empower investors, founders, and industry participants alike to navigate these new markets confidently. So this week, we're highlighting 40 founders, all founders you can back right now across everything from healthcare and AI to sports and CPG. We will also be speaking with our amazing sponsors and leading industry players here with us as well to give you the inside scoop on new frontiers of investment opportunities available to you from VC to high-end cars and everything in between. With that, I'm excited to welcome our keynote speaker, Michael Collins of Alumni Venture Partners, to kick off Investment Crowdfunding Week. He's one of the leading pioneers of the digital private markets. He and his team have created one of the top 20 venture funds in the United States, all the while democratizing access to the venture asset class. Today, he will be diving in on his 30 years in the industry, how alumni has done things differently, and of course, how you can invest if interested. So with that, I will hand it off to Mike and thank him for joining us and being a supporter of this incredible week of educational content. Mike, thanks so much for being here.
Thanks, Chris. Look forward to it.
Awesome. So we'll let you kick it off here and give the keynote. I'm excited to learn more.
Great. Well, I'm going to hop right into it. Let's get going. So again, I started in venture capital in 1986. So, probably before some of the people attending were born. But venture capital has come a long way. Obviously, this was a whole different world when it came to investing, technology, not widespread use of laptops, let alone the internet, mobile, cloud, AI, etc. So, but at the end of the day, venture capital is an asset class, and it's really about the deals you get into. So, the name of my presentation today is It's the Deal Stupid, and 20 minutes really on 30 years of technology, venture capital, and entrepreneurship. Going to talk a little bit about a few key points, but I'll try to keep it brief, and I'll leave a few minutes to check in with Chris and any questions people might have. So next slide. Oh yeah, the lawyers. So yeah, this is my opinions. This is not investing advice. So use some common sense. Next slide. Okay, so four main points from today. Why VC matters, things that I'm seeing, and opinions I have about what's working now and what's likely to work over the next 5 years. A little bit on how VCs think. And I think this is valuable not just for investing and venture capital investing, but I think there's some lessons for life. So I'll share my opinions on that, and then talking a little bit about deals. So my firm that I founded 11 years ago is Alumni Ventures. Really came out of a very simple idea that venture capital is a really important asset class, but really tricky for individuals to do on their own. But if we got together, we could do better together than any of us could do on our own. So it comes back to this point of getting into the good deals is really hard, and especially hard for individuals acting alone. It's especially hard really early. You can get in later, maybe, but getting into great companies early is very much a club sport. So I built a company built on that premise, starting with alumni of top institutions, and we raised 1.5 billion so far. We invest about 300 million a year. We've invested in some 1,600 companies. We were ranked last year by CB Insights and this year by Time as a top 20 VC, alongside names you'd recognize. Sequoia, A16Z, Bessemer, etc. Those are the folks we co-invest with. Alumni Ventures is unique in that we don't lead, we don't sit on boards, we don't price rounds. We're a co-investor. And because we're this amazing network of people, we get into some really cool deals. Here's just a few of the companies that, a few people might recognize. Rigetti and Upstart are public. Circle actually just went public. Aura is the Aura ring. A lot of people wear those. I could go on. We have an Apex 50 of 50 of our most well-known investors. You can check those out on our website. But we get into really good deals. Next slide. My background. Yeah, I grew up in Wisconsin. Parents are teachers. Came east to go to school. Uh, Started at a firm called TA Associates in 1986. But I've been both an investor, a VC, and an entrepreneur. Obviously, I think of myself probably more as a fintech entrepreneur over the last decade. And really, like a lot of good entrepreneurs, I built the product and service that I wanted for myself. And we have the largest community of individual investors. We pool money, we get into the best deals. The network itself helps access, helps with due diligence, and actually provides value to our portfolio companies. So it's a win-win. Next slide. Okay, so point number one, why VC matters. Um, I think everything is downstream of technology and innovation and entrepreneurship. If you look at where the value is created in our world today, it's really dominated by capitalism. Um, and capitalism is dominated by innovation and entrepreneurship and technology. And just a couple of things to keep in mind, which is you can take an Uber ride for 30 minutes from SFO, San Francisco Airport, and you're going to find something like $20 trillion in market cap, which exceeds the GDP of like Germany and Japan. So literally, these companies did not exist or were just getting off the ground when I started off in the business. And they really have really driven the world economy. Um, you know, you all hear about the Tech Seven, the Mag Seven. There's probably another 25 companies that are just below that. Um, and it really is where value is created. I just got back from Korea and Japan, and they recognize that this is not just a matter of growth and GDP, but it's also really a matter of security and sovereignty. As you're seeing AI, I think you're seeing quantum computing, I think you're seeing defense tech. If you're going to be a country or a state or a company that is in control of your own destiny, you better be leading in technology. We are also in a pretty interesting time of geometric growth, and most of you know humans aren't very good at that. We're used to seeing the world kind of progress slowly in a very linear fashion, and we're seeing technology move things forward at a really fast and accelerating pace that creates a lot of potential for disruption. Um, so with all these technologies taking place in compute and AI and genomics and energy, um, there's going to be new winners and new losers. Again, at the country level, at the company level, um, just enormous value being created. Um, and one thing that has changed is a lot of these companies, um, when I was starting out in the industry, would be public. Companies are staying private longer. So, you have Apple that went public at a 400 or $500 million valuation. You have companies now raising $400 or $500 million privately at multiple billion-dollar valuations. And I don't think that that's likely to change in the near future. So you're seeing more and more value being accrued privately. And so, as an investor, if you're going to wait for OpenAI to go public at $1 trillion valuation, you've missed out on the first $1 trillion of value creation. So, I think the idea of having a well diversified portfolio, which obviously is going to include equities, one needs to really strongly consider private companies, companies that are venture backed, either early stage with a big diversified portfolio and kind of a late stage venture, which would include these myriad unicorn companies to complement your public holdings. Next slide. I would also say you're seeing this with kind of the whole idea of kind of model portfolios. Alternatives aren't alternative anymore. So you're seeing this with pension funds, endowments, billionaires, family office. They're understanding that just kind of fixed income and equities is not where you need to be. People are considering early stage VC, late stage VC, crypto, gold, cash, private debt. It's a much more sophisticated view when it comes to all kinds of assets. Obviously, equity being a big one. And so I think a disproportionate effort really should be focused on one's kind of public equity strategies, um, their late stage privates, and then their venture capital allocations. And then individuals are catching up, right? They're getting educated and again appreciate the work being done by the team here. The more people that are participating in this growth economy, the better. But I do think one needs to obviously adapt this to their current time horizon and investing needs. But this is just saying, where the smartest kids in the room are thinking about allocating equity is for a pretty good reason. But there's a huge move away from, what existed 10, 20 years ago to a way more subtle and diversified portfolio. Next slide. So what's going on in 2025? Obviously, COVID was a disruption to kind of the normal state of VC. It was kind of a boomer bust period, really a boom and bust period that's largely been absorbed. I think we're back into kind of a new super cycle. Um, AI is everywhere. There's not a meeting that goes on right now that doesn't say, how can this foundational technology impact my business? Sometimes it's little, sometimes it's a lot, but it's on everybody's conversation. I do think it is the biggest technology innovation of my lifetime, and I've seen a lot. And so everything's got to be viewed through the lens of how is AI going to accelerate this, help this, or potentially hurt it. Uh, I think the capital markets right now are really kind of a barbell strategy. There's lots of money to get something off the ground, and there's a lot of money for, what I'll call very late stage venture. If you have an allocation into, Stripe or Anduril or something like that, lots of capital available. Series A is really where the rubber meets the road. That's where the companies that were able to raise a little seed money really have to show their stuff and are getting traction and show they can execute. And it's a really strong tell to us of a really strong lead VC putting in meaningful amounts of capital to lead an A is usually a pretty good tell. Um, it is also a market where great companies have their choice of capital sources. So there's really a strong correlation between the best companies and the best VCs. And that is because if you're a good startup and you're getting traction, you're in the right space and you can tell the right story, you get to pick who's on your cap table. So it's not because the VCs are smarter at the big brand name firms, it's because if you're running a company, you want that marketing branding event. So really strong correlation, and a really important thing to look at is who's leading the round and is it a meaningful commitment for them? Next slide. So again, I made this point, it's AI all the way down. So this is a big general purpose tech. It's really important to ask a fundamental question. Is the company I'm looking at investing in going to be helped by AI? Are they excited about the next release of ChatGPT or Anthropic or Grok? Or is this something that could be a feature in a future release? So, that's really a key question. AI can impact productivity. I think you're seeing companies get a lot further with fewer people and less money. They're moving faster. Um, Again, one of my early mentors, friend Clayton Christensen, coined the term innovator's dilemma. I think this is a classic case of a new technology that is going to allow new forms of disruption. Um, so, key question, key thing to unravel is the AI dimension of any pitch you're going to hear. Um, and it's just going to accelerate, I think, over the next 5 years. I think we're going to see a reshuffle of the economy. I think it's going to touch every parts of our lives. And that creates a real excitement if you are smart and invest wisely into that change. Next slide. So VCs, how do we think? How are we wired? Um, I think these are a few takeaways that I'll just share today. One is VC is a hits business. It's the deals you do, which is very different than a lot of other alternatives where you're really trying to, not lose money. Here it's about your wins. A friend of mine wrote something for Bessemer called the Anti-Portfolio, and it's all about the difference-making investments that they passed on. And if you're in this business, you're going to miss it. But you have to ask yourself, what can go right? It's the big wins that make all the difference in the world, not your losses. I think that's a really interesting thing to think about in life as well. Um, Portfolio size related to this, it's a hit business. Doing one or two deals a year probably falls in the realm of gambling and education and fun, not as the right way to invest in venture capital. We recommend portfolios of 50 to 100 companies as a minimum. That's where you're really going to have the reasonable chance to catch that once in a lifetime kind of opportunity. Every deal we do, we think is going to be a home run, but this is a very hard business. There's a huge mortality rate, and you really need a large portfolio of deals led by top-tier VCs. Time. There's a bunch of arbitrage to be a good investor as a VC. You have to be patient. Most people aren't patient. Most people like to day trade. Most people want to check their stocks 5 times a day. If you have the ability to think, beyond your nose and think about years and maybe even decades, there's a real advantage to that. There's also a lot of noise. If you can kind of arb out the noise of the day about government shutdowns or trade deficits or the yen carry trade or whatever the heck it is, at the end of the day, our business is about great entrepreneurs working their ass off to build different making businesses. Really hard, takes a long time, and little stuff doesn't really matter. Um, Fourth point I'll make about how VCs, there's two numbers that you want to care about. One is return. your IRR, which, is this a 3x? Is this a 5x? Is this a 10x? And then it's about how much money do you have at work, right? So obviously making 10x on $1 million is better than 10x on $100. So keep both things in mind, which is venture capital a lot of times is putting more money to work over time as the companies you're investing in show performance. So thinking both about IRR, total gain, when do you take chips off the table? Am I buying right and I'm selling right? All of that goes into the equation. But at the end of the day, this is still a people's business. There's too much time typically spent on total available market. What's the strategy? A lot of great businesses evolve and pivot way beyond where they start. The great businesses, what do they have in common? Is a great founder and a great entrepreneur who figures it out. So this is a business really about pattern recognition, learning to identify great jockeys, and going along for their ride. Next slide. All right, so final points from 30 years of doing this. Um, Again, I talked a little bit about arbing out noise. Cycles repeat themselves. Things get hyped, things go boom, things go bust, but through all of that, technology advances. Great improvements are made. Unintended consequences create new problems that then need to be solved by the next generation and the next foundational technology. You have to really weather booms and busts and focus on process. This is a business that requires humility. You are going to make a lot of investing mistakes, but if you have a big, smart, diversified portfolio, if you invest consistently with good people, you do really, really well. I mentioned this as well. It's about the network, it's about the people, it's about developing pattern recognition, making connections, trying to add value. That is a career. That is an investing cycle that takes a long time to build, but it is an incredibly valuable asset when you do it. And then just, you have to enjoy the journey and you have to be patient and you have to put in the work. This is a get rich slow business that requires a lot of grind. Good things in life are hard. They take a lot of work. They take a lot of time. You have to kind of put in that time to do well in this business. Okay, and with that, I think I've blown through it pretty well. Next slide. Oh, yeah. So at the end of the day, it's the deal, stupid. Do not lose sight of it. Get into great companies, go along for the ride, found great backers. That's what this is all about. This is about owning equity, being an investor, being an owner in a great company. And if you have one or two of those in your career, it can make all the difference in the world. And I think my final thing on the last slide here is just if you're interested in venture capital, we have a syndicate. It's free to join. You have to be an accredited investor. Um, and we're pretty open on the deals that we're doing. So some of these deals, we have an allocation we make available to our investors and our syndicate members. So I think next slide, we have a little QR code um, that people can join. So this is my commercial. If you like the idea of getting into really interesting companies, if you want to learn, if you're committed to building kind of a venture portfolio where you're co-investing alongside really good VCs, we make signing up and seeing the deals pretty darn easy. So entirely free, entirely optional, no obligation. But we're big believers in the best way to learn about investing is to see deals that are being done and to put your chips down when you have conviction. So if it's something you're interested in learning more about, again, we have a pretty easy sign up. You can just snap a picture. And with that, I thanks for everybody's attention today.
Mike, thank you so much. I really appreciate it. And a couple things I just want to hit on really quick. What has always drawn me to you all? I'm totally bought into creating this access to the venture asset class, right? And the reality is you're a top 20 fund over the past 10, 15 years. And I think you're still really the only fund that lets people invest with, 25, 50K minimum check sizes when most of these guys aren't even raising from an
Yeah, in fact,
individual. And if you are, it's
a
millions.
lot of our deals, Chris, are actually 10 grand. So, it's kind of our mission. I think it's good for everybody that there's more democratization. It seems a little crazy that you can go to Vegas or you can log on to DraftKings and invest in whatever or some poly market thing, but you can invest in a deal led by Khosla and their A round is, a little wackadoodle. But we're trying to do our part there and, working on the legislative front to help out, but also just by having the deals that we're doing um, available when we can, I think again is something that is the right thing to do.
I love it, Mike. And I think we have time for one question here, and we'll certainly send you the other questions and try and get folks the answers as well. But I think this one is really relevant. I had it on my mind
Yeah.
too. Data shows that fundraising rounds and AI prices at 25 to 30 times EV to revenue on medians, with the top companies trading well above that. OpenAI at 40x, Anthropic 44x, so on and so forth. So, are the days of inflated valuations of the early 2020s really behind us? And how do you think about that?
Yeah, I mean, it is very much a case by case basis, right? So I think one has to be very careful about making the market is overpriced. This is, it's reasonable, it's not reasonable. It's you have to look at it on an individual situation basis, right? And you look at the growth rate, you look at the margins, you look at the moats, you look at the team's ability to execute. You have to say, in the venture business, is this something where, I can make 5 or 10 times my money in 5 to 10 years? What's the risk adjusted return kind of thing? Um, it is easy to miss on both sides. I'm old enough to have been in rooms where people were appalled at, Google raising money at $100 million valuation, right? And because it was way outside kind of conventional norms. And that was a miss if you passed on Google at $100 million valuation, right? So I think your entry point is important. Valuation matters. You need to not say, I want to own a company at any price, but you really have to do the work. And I think it's on a case by case basis, as I say. And, if what we have seen, not all, but I think we've also seen, Chris, in AI, we have seen once in a lifetime ramps of revenue, right? So, I mean, I think we're seeing companies go from 0 to 1 million ARR, from 1 million to 100 million, in record time. So I'd love to give an easy answer, but I just don't think there is one. I think the later you go and the more brand recognizable the name is, I think the more careful one needs to be. Because there are people now that are looking at the big names and they're kind of, I want to be in at any price. And it's a heck of a lot harder to make 10 times your money when your entry point is 500 million versus 25 million or
Absolutely.
500 billion versus 25 million.
Excellent. Well, Mike, thank you so much for your time and your thoughtful insights today. We'll be following up with the links as well. I've dropped it into the chat. Thank you, everyone, for listening in. Very powerful what you're doing at Alumni Ventures, and we're very thankful to have you here today, Mike.
Excellent. Have a good one, Chris.
Have a
Be
wonderful day.